But motivation led to impulse. What does that mean? What's your point here, ICT? What are you getting at? The things that make you feel like you want to be able, willing to, inviting the risks, you don't respect that same measure of risk when you are really at that moment where you could still say, no, I'm not going to do it. Let me sit still and not do it. So your motivation leads you to the dance. That means you're in front of the chart. You're sitting there, you're watching it. You have your silver bullet in mind. You have your optimal trade entry in mind. You have, whatever else I've ever taught that you've gravitated to as your model. You have your draw on liquidity. You believe it's going to go here or it's going to go there, and you're ready to see it. If it could just give you a fair value gap, you're in there. But then something magical happens. Something magical comes in and changes everything. It's like your perception completely changes, and it becomes sometimes like a language you've never read before, and you're like a deer in headlights. You're paralyzed. You knew what you wanted to do, but now you're in front of the charts and you're watching live practice action and you can't do it. You're waiting for something to appear as a nudge, a little, you're right, now take it. And many of us, when we first start, we call that confirmation. The only thing that it confirms is you sat there too long. That's what it confirms. You sat there too long. Now it's already moved. It would be better for you to wait for some kind of a down close candle in a lower time frame, reach into a fair value gap if you're bullish, and then use that. Don't chase running higher price when you're bullish. Don't do it. Don't do it. Because the only thing you're doing is increasing the likelihood of your stop loss needing to be larger than it's necessary to be, or making it harder for you to hold the trade, because you're going to know as soon as you enter it, you're going to be demanding subconsciously that it moves right away in your favor, and you don't want to see any kind of drawdown. Whereas if you're bullish, and this is how I teach, so it overcomes a lot of the built-in fears that are associated with being poorly placed in a trade or chasing price. So if you're bullish, I'm teaching you to buy what? A down close candle, or a candle that's forming a likely down close candle, but it need not close down. It could be trading lower and still have a higher close. But at the time of your entry, if you're bullish, you're waiting for price to go lower into an inefficiency or run below a short-term low to take those stops. So you're going to buy sell stops or buy inefficiency on a buy side imbalance, sell side inefficiency. You're going to buy that rebalancing to close up and overlap that up close candle that you're seeing as an inefficiency. So you're buying against the grain of price delivery versus impulsively chasing it. In the beginning, because you think as a trader, just like I did, I want to be in a market that has the market going up. Like I want to be in a move that's going up. It's too scary. I'm speaking hypothetically and in retrospect to how it was when I first started. So as a 20-year-old, I was afraid to buy things when it was moving lower. To me, it made no sense. I mean, it literally made no sense whatsoever to go in and try to pick a bottom. That's what I was looking at it as, because I heard my mentor say, you got to avoid trying to pick bottoms. They're like catching falling knives. You have to wait for that dagger to fall, hit the ground, stop quivering, then gingerly go over and pick it up. That's verbatim. That's literally right out of that Ford cassette tape VHS course that he had from 1995. It was ingrained in me, just like the things that I say to you as your mentor. I'm not in the room with you, but you'll see something in the charts and you'll hear my voice saying the very thing that you had a resonation with in a video or a lecture, maybe something in this one today. And you'll hear my voice, you'll know it's